In this week's video, we'll review the latest charts to help us answer the question, is it all about to come crashing down in the stock market? In this segment, we'll be reviewing a long-term quarterly chart of the Russell 2000 small cap index relative to long-term U.S. Treasury bonds using a mutual fund, in this case with the ticker symbol WHOSX. We're using WHOSX because its history goes back a little bit further than TLT, but you can see they're very highly correlated, and for the most part, they zig and zag together. So in the ETF world, we're basically looking at IWM relative to TLT. Calendar year 1997 on the left side of the screen, the present day as of July 24th, 2018 on the right side of the screen. The ratio of small caps to U.S. Treasuries has been inside this box for 21 years. And if we draw a horizontal line across the screen here, we hit price several times, which is the definition basically of sideways movement or consolidation. On a quarterly basis, the ratio came up to this level here in 1999, came up to the exact same level in the year 2007, and in both cases, the ratio was rejected, meaning long-term Treasury bonds started to significantly outperform small caps. 2007, long-term Treasuries were a much, much better place to be relative to small caps in this area here. If we fast forward to the present day, it looks a little bit different. Rather than being rejected here or rejected here, the ratio is trying to make a breakout above the orange box that it's been inside for 21 years. And since we know the longer a market goes sideways, the bigger the move that we can expect to get when we either get a bullish breakout or bearish breakdown. As always, the longer the ratio stays above the orange box, the more meaningful it becomes. If good things happen for a long period of time, and the chart tells us to be open to that scenario, then small caps would outperform long-term Treasuries significantly in the coming years. That aligns with one of the theories that we've covered in recent videos, that stocks, from a probability perspective, most likely will significantly outperform bonds. We can also summarize some previous topics with this chart pattern here. You can see we have somewhat of a left shoulder, a head, and a more shallow right shoulder. It's not a perfect pattern, but the psychology of the pattern still applies. The psychology behind an inverse head and shoulders pattern, which is a potentially bullish pattern, is that in this area here, we get some early adopters that are saying something is wrong, and they start migrating to long-term U.S. Treasuries relative to small caps from a conviction perspective. When we get to the peak in 2007, the majority of the crowd between this point here and this point here realizes something is wrong. And the left shoulder psychologically tends to be late adopters. They don't believe in this rally off the 2009 low. And when the ratio starts to fall here, they see something's wrong. But as we mentioned earlier, this rally here is significantly different than this termination point here and this termination point here, which is another way of saying present day odds are much more favorable right here than the odds were here or here. And this ratio, which is dated July 24th, 2018, meaning this is a very recent breakout that we're getting here on the quarterly chart. It's very, very easy to understand, looking backwards from this point here, why so many people are skeptical about the stock market in general. It's very, very easy psychologically to say, we've seen this movie before, and we're not going to be fooled again. And as we've covered in past videos, this is potentially a form of recency bias. It's logical for people to be skeptical in here because when they look back 21 years, all they know or all they've seen is evidence that tells them they should be skeptical up here. Another present-day stat that ties into past themes in these weekly videos. From Bloomberg, July 25th, 2018. Almost 1 in 3 millennials said cash instruments, such as savings accounts and CDs, are the best place to invest money they won't need for the next 10 years. As we know, this is a form of skepticism. This is money on the sidelines. If we do a little digging, it's very, very easy to understand why millennials might feel this way. This is a chart of the S&P 500 here. This is 1997. Gets rejected in the year 2000 and really bad things happened. Which means when we look backwards, this move here ended badly. When we look backwards, this big move here ended badly. So when we get back to the top of the box, as we did in 2013 in the S&P 500's case, it's easy to understand why people believe and continue to believe this will end badly. Think of the psychology of people in 1997. In 1997, if you were 7 years old, in 2018, you're 28 years old. So when you look back, this is what you know. And anyone in between, all the way up to 55 years old, if you were 55 years old here, you're 76 years old today, which means anyone from age 28 in the present day to age 76, which is the vast, vast majority of market participants. Based on their experience, it's very, very easy for them to say, we've seen this movie before, and we're not going to be fooled again. But as we've covered in past videos, that's not really the way markets work in the real world. We covered this in May. This is the Dow, 1926, and we'll move all the way out to the year 2018. If you were looking backwards here in 1954, you could look all the way back to the 1920s. And when we get this bullish breakout here, it would be very, very easy for you to say, this will end badly, this will end badly, this will end badly. Thus, the main market demographic has a bias to be skeptical here. Did it end badly at point A here? The answer is no. Instead of ending badly, the Dow rallied for an additional 18.5 years after the breakout from the box and tacked on an additional 205%. The longer a market goes sideways, the bigger the move we can expect to get. We also know at some point the market needs to consolidate its gains. And that's what happened after the 205% gain over 18.5 years. We went sideways for a long period of time again. And then we had a bullish breakout here in the early 1980s. It was very, very easy to understand how people would say, this breakout is going to end badly. When they look backwards, their personal experience aligned with this will end badly. Is that what happened? The answer is no. Instead of ending badly from the breakout point here, the Dow rallied for an additional 17 years. That's an additional 17 years. It doesn't count the move off of this low. This 18 years does not count the move off of this low. So when you're here, you could have said stocks have been going up for a long time, this will end badly. When you're here, you could have said stocks have been going up for a number of years, this will end badly. After the rally, and this was a big rally, over the 17 years, the Dow tacked on almost 1,000%. All good things must come to an end, and the market consolidated its gains again. Seeing a pattern here. Sideways movement, secular trend, sideways movement, secular trend, sideways movement, recency bias, a bias to say this will end badly here at this breakout point, just as it was logical to be skeptical here and here. If this move here in the Dow was similar to this move here and this move here, and this video and chart was made in May of 2018, from that point, it's not unreasonable that the Dow could rally for an additional 13 years and tack on an additional 377%. And as always, this is not a forecast. We're simply making probabilistic statements based on the facts in hand, just as we could have made a probabilistic statement based on the facts in hand here and the facts in hand here. As long as the facts support that theory, which they did in this case, and which they did in this case, then the theory will continue to hold water. If the breakouts fail, then we'll have to readjust our assessment of the probabilities. If you look at these numbers here from the close on May 8th of this year, hypothetically it says the Dow would move from roughly 24,000 in May of this year, and it would reach 116,000 in the year 2031. And if you are skeptical about that, I can guarantee you people were skeptical here. If you told people the market was going to go up for 18 years and tack on 200%, they would have said you're crazy. If you told people here in the early 1980s, where everybody said America's best days are behind us, nobody would have guessed that the market was going to rally for an additional 17 years and tack on 1,000%. If you're skeptical in here, that's the way we're supposed to feel. That's part of the script. This is the Dow. This chart is noisy, so let's simplify things a little bit and look at the same concepts with the S&P 500. This is a yearly chart using the simple 8 and 9 year moving averages for illustrative purposes only. Sideways movement in the moving averages, a bullish breakout, a bullish cross with blue above red. This will end badly. Didn't end badly, rallied for 23 years, an additional 23 years. That does not include the move off the low, and tacked on an additional 580%. Market needs to consolidate its gains. That's exactly what happened. Moves sideways for a very long period of time. Very easy when we get this bullish breakout with blue moving back above red. People would say in the early 1980s, this will end badly. It didn't end badly. In fact, it didn't end at all. We rallied for 18 years and tacked on an additional 1,100% in round figures in the S&P 500, and that does not include the move off of the low. That's the move from the top of the box to the peak here in the year 2000. Consolidation is typically followed by a secular trend. Consolidation is typically followed by a secular trend. Therefore, we would expect to see consolidation next, and that's exactly what we got. Very, very easy to understand why people are skeptical here, just as they were skeptical here, and they were skeptical here. This chart is dated November 8th, 2017, but since the market has moved higher since November 8th, 2017, and is green year to date, we really don't even have to look at an updated chart. We know blue is still above red, and we still have a constructive and bullish breakout. The longer the breakout holds, the more meaningful it becomes. Is it possible in the present day that this breakout fails and really bad things happen? We know the answer to that. Of course it's possible. But there's a big difference between possible and probable. So let's compare this point here to the peaking process in late 1999 in the year 2000 and the peaking process in 2007. So we'll move on and we'll still be looking at small caps relative to long-term treasury bonds. This looks a little odd. Bear with me, we'll explain it. This is where the S&P 500 peaks here in March. This is March of the year 2000. This is the 50-day moving average in blue. We've removed price because we get a lot of volatility near peaks. What we care about is, in this case, looking at a short-term time frame after a peak, is the intermediate trend, and also is it spilling over into the longer-term trend. So this tells us after the S&P 500 peaked, which is right here, it's very, very clear that the conviction to own defensive-oriented treasuries was much, much greater from a trend perspective than the conviction to own growth-oriented small caps. And this is what the trend looked like 179 days after the market peaked, the S&P 500 peaked, again in March of the year 2000. This is as of September 19th, 2000. How does the exact same chart look today, 179 days after the S&P 500 peaked? The answer is much, much better. Got the same thing here. This was where the S&P peaked. This is where the S&P peaks in late January of this year. The intermediate term trend, 179 days after the stock market peaked, really doesn't look anything, not even remotely close to this move here. At the end of 179 days, the 50-day moving average has moved from the upper left to the lower right. That's a downtrend. 179 days after the peak in the present day, the 50-day for our ratio has moved from the lower left to the upper right. That's an uptrend. This is the look we want to embrace. This is the look we want to avoid. These charts tell us that the market barge, which is the big players, in the year 2000, the barge started to turn. Institutions see the problems and big money is flowing. We don't have that in the present day. The barge is not turning. The barge is still moving on a bullish course 179 days after the peak, telling us that the year 2018 relative to the year 2000, the probability of this chart here morphing into something as bad as this, given what we know today, it's not zero, but it's a low probability. How does 2018 compare to the peaking process in 2007? We already know what the present day chart looks like 179 days after the peak. How does the exact same risk-on, risk-off ratio look 179 days after the S&P 500 peaked in October of 2007? And we'll be looking into 2008. In this case, the answer is much, much worse. This is our barge starting to turn on an intermediate term basis. This is our barge still sailing with a bullish course. This really doesn't look anything like this. And this, a bullish breakout, really doesn't look anything like price getting rejected here or price getting rejected here. What once acted as resistance, all of this may now act as support. So even if price moves in this direction, there is potential support here, 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 and here, telling us that the risk-reward ratio of entering growth-oriented assets relative to defensive assets is excellent here. There's a lot of potential upside and a lot of potential support below if the low probability outcome wins the day. There's a lot of potential upside. And if you entered here, a lot of support, potential support behind you. If you entered here, a lot of potential support looking in the rearview mirror. In this case, from a long-term perspective, the breakout held. In this case, it held. Blue stayed above red the whole time. Blue stayed above red the whole time. In November, blue above red. In the present day, blue above red. The future, to be determined, and we'll take it day by day. Well, this type of analysis always leads to the next question. Are you saying small caps are the place to be? If you're a client, you may have noticed that we added a very, very small position in small caps to the portfolio this year. Why is it so small, and why do we have it? If you were to ask us, what do you think about small caps, we would say, we're not really sure you asked the right question. You should be asking, what do you think about small caps relative to every other option that we have out there? Investing is about opportunity costs. If I buy small caps, that means I can't buy something else. This is the long-term trend. It's a monthly chart dating back to the year 2000 here, July 25th here in 2018. This is the 50-month moving average. The trend favors small caps. It rolls over in calendar year 2014. Instead of the bias being the ratio is above the 50-month moving average, the bias now is that it's been below. Instead of the slope being positive and bullish for small caps, right now it's flattening, but it has been negative. So to answer that question, are small caps the place to be? For our purposes, we're not sure yet. There is some improvement here. Price is above the 50-month. It's trying to flatten out and maybe turn back up. Right now, we do have a higher low relative to this low, but we don't have a higher high yet in the ratio. For the most part, this still looks like a downtrend with a breakout, and the downtrend favors SPY over IWM. This is step one, basically, here. We have a bullish breakout. Now we'd like to see some evidence of a series of higher highs and higher lows. We already have one higher low. At a minimum, we'd like to see a higher high. Taking the small position in small caps helps us psychologically. Now, we're not rooting against or for small caps. If small caps go up and the ratio goes in this direction, no problem. We own some. We're happy to add to it. If small caps fail and this trend that for the most part has been favoring the S&P 500 over small caps resumes and or stays in place, we don't care about that either because our position in small caps is relatively small versus the entire portfolio. It's an incremental approach from a money perspective, an allocation perspective, and maybe most importantly, a psychological perspective. Now we can view this chart with a flexible, unbiased, and open mind because we own both. Now remember, we said, if you said, what do you think about small caps? We said, we're not really sure you asked the right question. What do you think about small caps versus every other option, including technology stocks? This is small caps, IWM, relative to an equal weight technology ETF, RYT. As of July 25th, 2018 at 1:45 p.m. Eastern Time, this chart has a lot of work to do to prove to us that we would rather be in small caps relative to tech. This ratio just made a new low here. It hasn't made any important higher high, and it hasn't broken above a trend line. Like everything else we do, the market will decide. If it makes sense to add to small caps, then we will do so if the evidence supports that. If it makes sense to keep our small position or even cut it later on, we're happy to do that as well. It's extremely important to note, when you look at this chart here, it doesn't mean we're bearish on small caps. This is a relative chart. The S&P 500, SPY, IWM, and tech stocks, all of the charts in isolation are healthy, and the odds favor all three of these ETFs moving higher in the coming years based on the facts that we have in hand today. These charts help us with the opportunity cost question. Would we rather own? Would we rather own? We just said that 28 to 76-year-olds in the year 2018 have seen bull markets end badly. Is that showing up in present-day choices and psychology? The answer is yes. This was a poll. Millennials are the only age group to favor cash investments. When asked, what is your favorite long-term investment? 30% of millennials said it's cash. That's quite a bit different than Generation X, the baby boomers, and the silent generation, especially when we look at these groups in aggregate relative to this group. If you've been in the markets for a long time, you've probably seen this data before. You often hear that it's bearish for the top 5 stocks to be such a large part of the market, and the market is being carried by a few companies. That is totally normal. Reality, the top 5 often have a bigger weight than the bottom half. That's not unusual, and it passes the common sense test. If there's 500 stocks in the S&P 500, 5 of them would be the top 1%. The top 1% in any field tend to make a lot more money, and they tend to be a lot more successful. And history tells us, this chart goes back to the 70s, and this is from Ned Davis Research, a very reputable source, that it's not unusual at all to have big name stocks be market leaders. And it's very, very difficult to understand how anyone could be concerned about market breadth. Common sense tells us that if the total stock market index is making a new all-time high, then the vast majority of stocks are participating in the move. The total stock market index has never been higher as of the close on July 25th. That is not weak market breadth. It gets even better here. The value line geometric index, equally weighted and contains roughly 1,800 stocks, is on pace as of July 25th to print a new all-time monthly closing high, never been higher. In this chart, like the other charts that we've looked at, the average stock, the longer we go sideways, the bigger the move we can expect to get. Yes, you can find some breadth stats that might look concerning, but there's no possible way to say breadth is a problem when this chart is making a new all-time high. And this chart is making a new all-time high. This is what concerning breadth looks like. Notice here, the average stock peaked in calendar year 1998, well before the S&P 500 and NASDAQ peaked in the spring of the year 2000. This is weak breadth that would be more concerning. The average stock never recovered really from the plunge in 1998. The major indices went on to make new highs, all 3 of them, but the average stock didn't even get close to this high in 1998. Not the case today. As small caps and the NASDAQ have pushed on to new highs along with the total stock market index, the average stock on a monthly basis is trying to do the same. This cash here could be redeployed into growth-oriented assets when millennials get sick of hearing people say how well their stocks are doing. This is potential fuel to help this ratio move higher. And if this ratio moves higher, then the odds of good things happening for a long period of time will increase. And it's also fuel to potentially have the S&P 500 move higher for a long period of time. As always, we will continue to take it day by day. To keep our ego in check, it's extremely important to maintain that flexible, unbiased, and open mind. It may also be worth a visit to the new website to see the FAQs. We've got new and expanded FAQs covering traditional investing, low-cost passive investing, and the online/robo strategies that are currently in vogue. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or offer to buy or sell any security or any related financial instruments, nor should any of the content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shavaco Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.